I've been talking about the overvaluation for a little while now. Markets can get irrationally exuberant. Greenspan's old saying from 1996. And so certainly this could be the catalyst that sees the market roll over.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, we had another successful screening of the movie that we're showing, The Psychology of Retirement. It's at the Majestic over in 144th and Maple. Two big crowds came in, and this movie is really resonating with people.
It really is. It was standing room only, as I understand, and
the second showing, especially the 6:30 show. Yeah,
so
I was there.
So the good news is, if you'd like to see this movie, it's a very, very well done documentary, just producing to make sure you understand what you're facing going into retirement: the debt, taxation, Medicare, all these decisions you have to make, and 62% of Americans, Chip, do not have any type of plan whatsoever for retirement. So most of them are ill-equipped, regardless of asset levels. And that's the great thing is this movie literally interviews 6 to 8 real baby boomers walking in or already in retirement, and they have, some of them are a couple $1 million saved, some of them only have a couple $100,000 saved, but it just talks about the very real decisions they have to make, and it's been very, very well received, and that's why we were happy to step up and help produce this movie and invest in it.
Well, you are one of the executive producers of The Psychology of Retirement, and you mentioned the people who are interviewed. They're not stupid. They're smart people. There are a lot of moving parts to retirement in the 21st century. As you often say, you don't know what you don't know, not because you're stupid. There's so much to keep track, starting with the tax code and all these other moving parts to retirement. Your friend Morgan Housel's the narrator, New York Times best-selling author. David Walker, the former Comptroller General of the U.S., we brought Walker in here a couple of years ago for our September speaker series. There's a power-packed analysis in this movie.
And we're going to probably have Becky Swangberg, who's another expert featured in the film. I think she may be, we're working on it right now, she may be our featured guest for our September series.
Oh, fantastic.
Kind of this year. So we may have another voice from the movie for everyone here locally to hear.
Keep listening through in Omaha and Lincoln over the course of this year. We'll be showing the movie again, so stay tuned and keep listening, and we'll let you know when the next opportunity comes up for The Psychology of Retirement. Speaking of Lincoln, David, we're getting closer and closer to opening our Lincoln office. I saw pictures of some walls being finished and so forth. Oh, there they are on the screen for the YouTube watchers. It's becoming a reality now.
Yeah, I was down there all day Saturday building these feature walls, and yes, I was actually out there, hand in hand, hammer in hand, etc., and cutting these boards. My brother-in-law is a retired contractor. He's very, very well-skilled trim carpenter, so he helped me build these feature walls, you call them, just kind of accent the walls. We had a whole thing freshly painted from our good friend Joe Brim from Brim Painting, who's actually a member of my church and goes to a business life group with me for years. Used his services also. He painted this office for us. But anyway, so it's coming together, and we will be open in Lincoln here in about 3 weeks. So it's exciting. We've been hiring staff down there. If you know anybody that is interested in a career in financial services, and we're hiring for multiple jobs right now.
We've already had some of our tax planning presentations in Lincoln as well.
Yes.
So here we come, Lincoln. Well, David, we said last week that with Donald Trump as president, the news cycle will never be dull. The first article out of the chute this week, David, the headline comes from the Hindustan Times. It's not often we reference the Hindustan Times.
You have a subscription to this paper?
The only time we cite the Hindustan Times out of New Delhi, India. But the reason I grabbed it, David, is that this story resonated not just around the United States, but around the world. The headline is, Donald Trump to end income tax? What U.S. president said on tariffs and reforms as well. Now, actually, India was a nation that he mentioned in this briefing to Congress, India and China, about people that might feel some pain regarding tariffs. I think that's part of the reason why maybe the Hindustan Times picked it up. But this did reverberate around the world, David. Now, you have noted numerous times the United States of America was doing very well, thank you very much, without an income tax until 1913. But is this Trump bravado and bluster and posturing for negotiation, or do you think this could really happen?
It would take some serious work to really happen. And by the way, I'd be all for it, 100%. Let's get rid of the income tax and so many other regressive taxes on our citizens. The average American pays over 55 different taxes per year, according to the American Tax Foundation. And just look on the back of your cell phone bill, look at your cable bill. There are taxes everywhere. You get taxed on the income you earn. You pay sales tax to buy goods with that income you've got, and then you have to pay property taxes on what you've purchased. It's unfair. It's unethical. But again, what we're here to do is not tell you what the policy is going to be. We're going to react in real time to what the policy is and show you the best and most probable moves to reduce or eliminate and mitigate those different types of taxes you face in your life. Now, what's interesting about this is, yes, he would love to. It is more Trump rhetoric at this point. It would take talk about an act of Congress. I think it would actually take a convention of states, Chip, to make a constitutional amendment where you would have, you'd have to have 2/3 of the states ratify no taxation as part of our Constitution.
I mentioned 1913, the year before the Constitution was amended, and then Congress put it into statute. The code we have
with
now,
the bipartisan world we live in. Let's face it, there's about. Trump did win with a decent majority in this election, but it wasn't 60%, right?
Right.
When you have a 4 percentage point swing, that's pretty wide in the political divide today. It would take a 60% margin in Congress and Senate to really change this, and I see zero chance of that happening in the next 4 years. Mm-hmm. So the idea that income taxes would be eliminated is ludicrous at this point. However, could they be reduced? Could we replace some of that revenue all of the tariffs? And that's an absolute 100% certainty. Now, our new Treasury Secretary, who got it got confirmed earlier this past week,
Scott Bessent,
yeah, brilliant guy, and he's the same thing. He would love to see us eventually work to that. So what I think is you're going to see a buildup. Now, what will happen is if you really want to see income taxes eliminated, that might be 12 to 15 years out, if our debt were to actually reduce on some of their projected plans. But you got to remember, when we had 70% of our revenue coming from tariffs before we enacted income tax, we were only having to pay a very small sum of money to interest payments. The debt was less than 3% of our GDP. So it was nothing, It would be like me having to pay a $100 bill a month at the income level I'm at versus somebody else. And so it's very different. And so today
debt now exceeds GDP, doesn't it?
Yeah, we're at 126% as we sit here this morning.
So that's like saying if I make $100,000, but I owe $126,000, right?
So what we're going to do is, hey, we're going to stop paying you. Yeah, that's what you're saying, right? And how are you going to get rid of that debt? And so I believe we could work to it. It could be realistic to set the country on a path there. And again, I think capitalism is back in America. I'm optimistic on that. And I think we need to get back to teaching the basics of math and this Common Core nonsense. Let's teach people economics. I actually took an economics class with home ec when I was in school. Now, that was middle school when I went. They called it middle school. So when I was in 8th grade, you were required to take wood shop. It was required. It wasn't elective. You had to learn how to use the tools like I just used building the Lincoln up. You had to learn how to take care of yourself. Then you had to take home economics and how to, we had to learn how to boil an egg, how to make toast. I mean, the most basic so you could feed yourself. And I lived out on a farm. We didn't have TV. I mean, these were valuable skills, but we learned how to balance a checkbook. Do you think they're teaching that in high school today, Chip?
Well, some places are trying to make a comeback with financial literacy courses and so forth.
And so, but we got to start earlier. You can't just have it be a 6-week course right before you graduate to certify. Yeah. Okay, because they'll just use AI and cheat. So we need people to be taught the fundamentals early. I think we should, I think I could show you how to solve Social Security in a heartbeat. I think we should put $1,000 in an account that invests in the S&P 500 the day your child is born. And you should let corporate America or family members contribute to that account. The caveat: you can't touch it till you're 70. End of story. Period. It's not a surrender. It's not. And if you pass away, it goes to the national debt. But oh my gosh, you could stop Social Security for anybody that's under the age of 15 tomorrow. And you would solve our problems. And I already talked, I've talked extensively, and we're going to have Sean talking about this. The next generation has been named. It's called Generation Alpha. That's the generation behind Gen Z. And they're a much, much smaller generation. Millennials are not having a lot of kids, right? They are having less than 1.5 children per married couple. That is a disaster because we are not replacing our folks. So again, we can discuss the demographics and all these things and how they economically affect the country long term.
The Sean that you mentioned is one of our financial advisors, Sean Swanson, our resident authority on Social Security. You and he are going to go into detail on Social Security in the next segment of the show. And in fact, we've got another class coming up, more on that in the next segment. David, another big reach by Trump, maybe an overreach. The CNBC headline is, Trump says he'll demand that interest rates drop immediately. Now, your comment was, markets may say otherwise.
Again, you need to understand. So the Federal Reserve, right, the board, Jerome Powell, who now heads the Fed, is supposed to act independently of political pressure. We know political pressure is brought to bear by whoever's in office. It was, so I certainly think he would want to placate and Trump. But here's the thing. The Federal Reserve does not control interest rates. They control short-term interest rates, 90 days and less. So when they lower the Federal Reserve rate, and they've done it already 100 basis points, now currently the futures market are modeling 1 to 2 cuts this year as we sit here this morning, where everyone was predicting 8 or 9 cuts at this point, right? And so that hasn't come to fruition. But the Treasury market, the 10-year bond, the most important one we watch, has gone up 120 basis points from when the Fed first started cutting, and is currently sitting a little north of 4.5%. So while the Fed could cut rates, if they do right now, I would tell you, then interest rates will go up on the long end of the curve, which means mortgages will be more expensive, car loans will be more expensive, credit cards will be more expensive, and that is going to harm the economy. I know Trump wants the interest rates to drop, Chip, but let me tell you, you want to go into this conspiracy world. If you were advising Trump, I think I've talked about this on the show before, wouldn't you want the market to correct here? Because we saw this past Monday the biggest correction in history, right? Most market cap wiped out of a single company ever. $600 billion from one company, Nvidia, the high flyer of the last couple of years. Nvidia stock has risen an unbelievable amount, but it corrected 17% in one day. Well, that's created a tech sell-off across the board. We had a bit of a rebound a couple of days after that, but we are most likely looking at a repricing of this market. And if the market sells off, guess what happens? A flight to safety. People then go buy those treasuries, and if more people buy the treasuries, the yields get suppressed. They go down. So if you really want to get interest rates down, you would want, if you were the Treasury Secretary, as Scott's a smart guy, you would want to create a 20 to 30% correction in the price of equities across the board.
Get it over with, huh?
Get
Take
it over
the pain
with,
now and get it over
we're
with.
overdue for. And when that happens, you'll have a flight to quality, which would get the 10-year down in the 3.5 to 3.7 range, and that's when they'd refinance all this debt. Again, I'm just telling you, if there's smart guys in the room, that's what I'd be advising them to do. I mean, that's just the way it works.
Up next, as we mentioned, we have another round of Social Security classes coming up. That means it's time to check in with financial advisor Sean Swanson. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Smart Social Security Blueprint is one of our most popular classes. With us today is our resident authority on Social Security who teaches that class. David, please welcome our special guest, financial advisor Sean Swanson.
All right, Chip, thank you so much. Yeah, in the studio once again, our resident authority, Sean Swanson, on all things Social Security. And man, some major changes got laid down here just a few weeks ago. Biden's kind of one of his really, other than pardoning everybody, his last official act that's signing a law into place was is it Social Security Fairness Act? Is that what it was called?
Yes.
And is it fair?
Well, I'll tell you what it should. When they signed that, David, what it made me think of is the sound of a piggy bank breaking on the floor. The Social Security Fairness Act, what it does, it eliminates the reduction of Social Security benefits while entitled to public pensions from work not covered by Social Security. You want to translate that into English for our listeners?
Okay, so when you work for the government services, you do not pay into Social Security out of your paycheck. So therefore, you're not entitled to it. However, you would qualify for typically what's called FERS or SERS. These are the two main pension outlets of federal employees. Well, a lot of people worked part of their career for the federal government and part of their career out of it. And so if they didn't have enough qualification or they were getting the pension from the government, we had what's called the windfall elimination
provision.
Right? Yeah, so WEP, as we call it. And again, it did not affect a ton of our clients, less than 5%, but nonetheless, it's good for those people. And again, hey, whatever the government's willing to give you, I think we all pay too much. I certainly think you should figure out how to take what the government offers you. But as John Q. taxpayer, I'm visibly upset over this because you're taking people that did not pay in through payroll deduction for this benefit and are now going to be taking this benefit. And as we all know, the government's spending a little too much money. And again, we've seen a little progress here. The president's been in office less than 2 weeks now, and we are seeing over $1 billion a day savings start to compound. So this is going to shorten the life of Social Security by anywhere from 9 to 15 months by most estimates. Social Security is set to reduce your benefits, if you don't know, in 2033. They send you a letter. Just look on the back of the letter. By 18 to 25% of the projections. This is now going to accelerate that problem. How do we fix that? Why are they doing this, et cetera? I think it's buying votes. The administration on the way out the door did this. But again, hey, if you qualify for it, take advantage of it. But the problem for me, Sean, sorry to take up all the airtime here, is you're a pastor. Well, pastors had the opportunity to opt in or opt out way back in the early 80s. If you remember, under Reagan, the last time we made significant changes. Well, so a lot of them opted out because they just thought, okay, I need the take-home pay. They don't get paid a lot. I know the pastor that married me was living in a parsonage we provided and a very small stipend, did not have any Social Security. So now that, and he's passed on, but his wife is still here, has no Social Security benefit. These people don't qualify, right? It's only for the government worker that already has a pension. This is not fair, yet they call it the Fairness Act, kind of like that
Inflation Reduction Act.
Inflation Reduction Act, right? Oxymorons are everywhere in these acts. So anyway, I guess you're going to add some new content to the Social Security class we have coming up. When is that class?
Yeah, the Social Security class is coming up on February 11th. That's a Tuesday, and Thursday, February 13th. They start at 6:30 p.m., and we have them here in the Midwest Learning Center. So I want to encourage you, those classes do fill up pretty quickly.
Yeah, this is one of the most popular ones too. So
yeah, and we go through content that I know is helpful because you and I have both had so many clients come through the class and say, I remember when we covered that. And David, we also have a number of people that go to the class twice.
Yes.
They might go to it when they're 62, and then when it gets down to, I'm about to take it, they'll take the class again.
I just had this discussion with actually a friend who's not a client. He's been a friend of mine for almost 40 years. He turned 62 last year, and he was like, "Hey, listen, I'm thinking maybe I should go ahead and turn it on, And he had a recent bout with some health issues that kind of changed his mindset. I was like, well, we have a Social Security class. Why don't you attend it? And he's like, can I go to that? Absolutely. This is free to the public. But we also encourage our clients exactly that maybe hire us in their 50s or early 60s. When they get 62, we kind of automatically send them an email. Hey, you might want to attend this class. And as you said, usually we're telling people to defer to at least FRA age, not always, but that is typically the recommendation. And for a lot of folks, all the way out to 70 based on, life expectancy, taxation issues. And you cover in there not only how to draw it, what the penalties are, but you talk about the differences if you're married versus single. It changes that equation quite a bit, right?
It does, absolutely. We also run and make available to anybody that comes to the class that Social Security maximization report, which many people find quite helpful. So it's, from teaching so many classes, David, that we have this fine line between, we don't want to drown people with information, but we want to give them very useful data that they can use to make an informed decision.
Yeah, I know. When I first started doing financial education classes and teaching, people's eyes were blown back in their head, hair on fire, even in the tax classes I teach you guys, and so I've learned how we have to dole this out in bite-sized information. But I think you've done a really good job of crafting this class, hence its popularity, where people find out the basics of Social Security, understand the penalties if you make a bad decision, and the likelihood that you make a perfect decision is it's less than 1/10%. There's actuarial studies. In other words, the only way we can make that perfect is if you gave us your date of expiration.
Exactly.
Put it politely,
yes,
right?
That would make
if
it
you
easy.
happen to know the day you and your spouse will both pass away, we can dial this in to perfection. But we want to make the most probable choice. And I think what's great in the class is not only talking about how to optimize it and give them the report, but or how to maximize it, as we say. And then we go one step further for our clients and optimize it. And by that, we mean show tax savings, right? Because sometimes making the wrong Social Security decision is a $50,000 tax penalty on your retirement savings.
Wow, well said. Absolutely. And I know we don't have time to go through it today, but the Social Security decision impacts all of the many tax planning strategies that we're known for. And so there's many times, David, where we want to try and keep a person's reportable income down in some key years so we can utilize some other tax strategies to their greatest effect.
Yeah, I got to tell you, and I argue with some other friends of mine who own financial firms across the country on some of these strategies all the time. In fact, I just got in an argument yesterday with one. In fact, our listening audience may know him because I was very polite to him on a YouTube video about a year ago, and we got into quite a healthy discussion on social media this past week on some of the very similar topics. And so one of the things that people are bringing up is, we don't have to worry about it anymore. We're not going to pay penalties for Medicare, or we don't have to worry about doing things like Roth conversions to worry about untaxed Social Security. We're not going to have an income tax. Now, if that were really true, I would tell you that's fantastic. Certainly, we're hearing the rhetoric of Trump say, hey, we want to eliminate income taxes, et cetera. The reality is it would take Congress to change the law. You can't wipe out income tax with an executive order. You would need all the senators, both bipartisan support to do it. Don't think we have that. And you would also have to wait to fund our government. And it's one thing, and one of the things I talk about is we funded our government. 72% of our government was funded with tariffs prior to having income tax. Well, that's when debt to GDP was a fraction of a percent. We are at 126% debt to GDP today. They're going to continue taxing Medicare, Medicaid through Social Security, right?
Yes. And one of the things we do talk about that people who attend the workshop tend to give me and you positive feedback about is understanding the different generations in America today.
Oh, absolutely.
Who's taking Social Security, who's not,
and who's paying for
in.
it, right?
Yeah, and you're the one that taught me that. And so when we talk about the entire Social Security barbell, it's very enlightening to talk about the funding and how, yes, under current law, funding is going to step down in now 2031, perhaps.
Yeah. Well, we now have Generation Alpha. So after Gen Z, we now have the next generation has been labeled Generation A or Alpha. I guess that makes sense, right? However, we have a very big shortfall here. Again, it's going to be a much smaller generation, same as mine, Gen X, right? We have a shortage of 18-year-olds. And by the way, these colleges need to be paying attention. We had 200 universities close their doors last year across the country. 200 universities closed their doors last year. Now, these are small private colleges, et cetera. But you're going to see these universities need to adjust because we have such a small amount of 18-year-olds this year. I think it's the smallest in over 30-some years of kids that are 18 years old this year. So that's a problem for the labor force, by the way, right? And so Elon Musk kind of talks about that. Anyway, all this and more is covered. So we managed to make a Social Security class talk about Medicare, taxation, demography, right? Demographics of our country, and a whole lot more. And you do such a job of just making it entertaining. Are you singing in these classes, by the way, now?
I might if you ask me to. I don't sing normally, but anything's possible, David.
All right, again, just remind everybody when the class is.
Yeah, they're coming up on Tuesday and Thursday, February 11th and 13th, beginning at 6:30 p.m. And please call and register. That's 402 369-7777, or you can register on our website of retiresmartomaha.com.
Actually, the new website is just launched. It's retiresmartnow.com.
All right,
either
good.
one will get you there, but you do have to register. The class does, Philip. We're out of time. Sean, thanks for stopping in the studio.
Thanks, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First one is about inheritance. Unless something goes horribly wrong, I'll be getting a significant amount of money from my mom, who is 86. It would more than cover my income needs in later years. I'm 55 now, and I don't want to rely too heavily on that money, but I also don't want to save so much now that I can't enjoy my present life and then end up with more than I need when I'm 75. How do I strike the right balance?
Well, one, I want to commend you for realizing where you are, right? You're saving your own money, and you realize that there is going to be some dollars passed on. So the questions would then be, do you want to pass dollars on to your kids, assuming you have some? Again, I don't know the full story here. But this is wonderful to see somebody at 55 being proactive because, as you know, most of the clients that come see us turn 60 before they ever walk in our doors. And we encourage people in their 50s to come in because the further ahead we can start the pre-planning and get the planning done, the more accurate the plan will be, and the more we're going to be able to give you confidence in knowing what you can spend. I literally was at a presentation we did this week, And I was talking with the audience how I struggle to get people to understand the first 5 to 7 years of retirement, I actually want you to spend more money than most people will tell you. But
The
I'll show
go-go
you with
years.
math. Yeah, we call it the go-go years. This is when you have the mental ability, the physical ability, and the financial ability to do things that matter to you. And again, it doesn't mean you have to be a world traveler. Everybody's got different bucket list items. It could be you want to serve a church, you want to go on mission trips, you want to take a Rhine River cruise, whatever it may be. But the longer you wait because you want to make sure, I just want to make sure I'm okay. Financially, you end up, now you talk yourself out of it. And the old curmudgeon, as I talk about, I mean, we had a client, he passed away, I think it was early last year, so it's been a bit. But he was in his 90s, didn't get married till he was 78 years old, Chip. And I don't want to give his name away, but he actually played basketball for a university here in state. And he waited, and that's one of his regrets. He told me, Dave, I waited and waited and waited. So he accumulated. You got to understand, is you just let money compound, it builds up. So when he got married, he'd already had accumulated over $5 million because he was single, didn't have kids. So he didn't spend any money. So he had over $5 million, but he didn't get married to 78. He passed away, he was 92. That fortune had more than doubled again, and he never enjoyed it, ever,
Yeah.
And so that was one of his regrets. And I've been blessed to interview a lot of people when they are close to the end because of the industry we're in. And, I will tell you, we would want to build this person a plan that shows them exactly how much they can safely spend so they can enjoy the fruits of labor and then still have the confidence that they're going to be okay. It's got to be inflation adjusted. We need to understand risk management. There's a lot to go to it. But if you're in this situation, if you're out there in your mid-50s and you're wondering the same thing, maybe you don't even know how much mom and dad are going to leave you. You save some money on your own, but you know something's coming down. Why not plan for it? Why not have those conversations with your parents if they're willing to? And I would highly encourage that.
Next question, David, is about the relationship with an advisor. What is the normal rhythm of a relationship between advisor and client? Basically, I don't have contact with my advisor unless I reach out to him. That isn't necessarily a problem. I suppose no news is good news. But when things get volatile in the economic and financial world, I sometimes wonder, what is your approach at Retire Smart? It's definitely not automatic pilot here. We have a constant rhythm of contact.
Yeah, we do. And we're always trying to improve ours, frankly. I'm always looking for better ways. In fact, we're using this awesome new studio here starting this month with monthly updates via video to our client base that'll be launching out here very soon because we want to communicate openly and actively to our clients. Now, I will tell you, when I first got in this business, I mean, I would tell every client, hey, we're going to meet every quarter. And, and it's not an economic reality, right? You're not going to meet with your advisor 4 or 5 times a year. You will, with a competent advisor, you're probably going to have 4 or 5 meetings in the first year because there's a lot of work to lay the foundation. But for most clients, they need one, what we call formal review a year, right? Which is anywhere from an hour to 2 hours, depending on the complexity of the case, and then touch points in between. Now, we host client events. We also do some fun events. It ebbs and flows depending on the climate, what's going on. We do ball games. We do wine tastings for newer clients, and we have some new activities coming for our existing clients as well. But we operate as a team. So you need to understand, too, is when I got in this business, you were all on your own. There was no teams. It was one advisor, and it's kind of like going to a generalist if you went to a doctor, right? You just go to a general practitioner or internist maybe. But when you get a certain disease state or a certain need, he's typically going to do what? He's going to refer you to the specialist in the area. We just had one of those on a few minutes ago, right, Sean? So we've built a team out. We have 17 licensed advisors on the team today. And we have somebody who we talk to about Social Security for all clients, all cases. That happened to be Sean Swanson, who's on. We have Medicare specialists. We have estate planning specialists. We have income specialists. We have tax specialists. So we divvy up the workload because no one advisor, well, me excluded, no, I'm just kidding, can have all this knowledge in their head, right? So what we have found is the team approach, the collaboration approach is what best works. So what that means, though, for the relationship with the client is you may not understand that your advisor's talking, and again, depending on who your advisor, what company, a lot of other companies have adapted this team environment. It's become very popular in the industry because it's better outcomes for the client. So the relationship, you may have one advisor who's your relationship specialist, if you will. He's the key contact for that family, but often we work in groups where there are actually hundreds of families, and each advisor is assigned a max of about 150 to 200 of those that he will control, if you will, that relationship. So what are you looking for? Do you want one person who's the only person you ever talk to, or do you want a collaborative team that can give you better outcomes in all situations? You have to decide that for yourself, and that's kind of how we devise our report card. And every Friday, my advisors all sit in there and have to present every plan in front of me and the whole entire advisory team of anything they're going to suggest.
Every folder is reviewed by every pair of eyes. I'm never certain if people understand that. You have the benefit of all of our knowledge and expertise.
It's one of the best things we had an
brought
advisor
to bear on your file.
So this next week we are hosting one of our we do it typically 2 or 3 times a year, our tax masterminds. We have 22 advisors coming in here to get educated on taxation planning for their clients from all over the country. Last year, one of the people that attended, he said, one of the most valuable hours I spent was sitting through that case review that you guys do, and even just reviewing when clients are coming in for reviews, what was important from their last meeting, what mattered, and they just saw that process and they started implementing it in their practice. So I just smile when I know that we're helping that many other people not directly affected by us here at Retire Smart, because listen, we're not the only game in town, certainly not the only game in the country. And so my mission is to help as many people as possible, which is why we've expanded our offerings here. But I also am willing to educate hundreds of other advisors across the country. As long as they're independent fiduciaries, that's kind of my parameter. Happy to help educate them.
Since you brought that up, David, sometimes we'll have someone new to us say, "Oh, wait a minute, I thought David Brooks was going to be my advisor. He's the guy I hear on the radio or see on TV." Everybody here is trained in the David Brooks method. So not only will your eyeballs see every folder, but everybody's working your method. So even if you aren't the lead advisor for that person, your influence, your impact is there at every step of the way.
We are able to drive the results much better by me not actually personally taking on any clients anymore, and I haven't for years, frankly. But I still oversee almost every client relationship, every planning opportunity. But I'm also able to spend now, as I had to transition into a CEO role. I mean, we have 44 or 45 employees as of this week. We keep scaling and growing, and I have to learn new skill sets. And so we are building the best team, in our opinion, that can serve our clients in the most efficient and productive way to get them the results they want. And that's what we care about, Chip.
Up next, has China stolen a march on the U.S. when it comes to development of artificial intelligence? We explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I do want to ask you about what's going on with DeepSeek and AI in China and so forth, but let's squeeze this in first. In the first segment of the show, Donald Trump, let's get rid of the income tax. Donald Trump, I will mandate that interest rates get lower. Yeah, okay. But Donald Trump also proposed something recently that may actually come to pass. He's offering a buyout of federal workers. There was the flap about, hey, all you remote people come back to work. Oh, that's bothering you? Well, I'll tell you what, we're looking at maybe a 10% of the federal workforce being bought out.
Yeah, so I mean, he's offered it to just about all of them, all the non-secure. So basically 88% of federal workers were given this offer, right? And here's the offer. You have till February 6th to resign. And all they do is reply, resign, and there's an actual contract in the email. I actually have the email. Was sent to me by a federal employee reviewing this, and basically you will be paid through the end of September. And that is, just so you know, coincidentally, that's as long as the buyout can be offered to federal employees without congressional support, without an appropriations bill. So he can do this via executive order. It is estimated between 8 and 11% of federal employees are going to take this buyout. It's further estimated that another 5 to 6% are going to be terminated for underperformance in the next 15 to 18 months. So if you're in that where you maybe weren't effective as you could be. And by the way, they can track your keystrokes. I mean, it's amazing all the technology they have, and maybe employees didn't realize it. We certainly know the past administration didn't care, but they are now serious about the performance and the productivity that each of these workers provide. And again, listen, if you're a federal employee, thanks for working, thanks for your service. But federal employees are overpaid what the private sector would pay for the same job by a factor of 1.4%. They're paid 140% of what the private sector would pay when you factor in all benefits. And so it's not right. As taxpayers, that is not a fiduciary responsibility. That is not effective use of our tax dollars if we want to run an efficient nation. And again, this has nothing to do with the federal workers. This is reality. We have $36.5 trillion in debt that has to get paid off. So I think this is an amazing opportunity for folks in my industry, because I know there is going to be about 300,000 people that are going to be unemployed here very, very soon, and they are going to need financial planning. And one of the things, areas that we are very specialized and have the tools, resources, we have specialized software, is for Fed employees that are retiring, FERS, SIRS, et cetera. So if you need somebody who speaks that language, we'd be happy to help.
We're here for you. If you in the listening audience, or you're watching on YouTube, and you are one of these federal employees taking a buyout, we're here for you at Retire Smart. All right, David, in the first segment of the show, you talk about the wallop that Nvidia experienced recently, and that ties in, I think, to this next headline. This is from Bloomberg. AI-fueled stock rally dealt $1 trillion blow by Chinese upstart. The Chinese upstart referred to here is a company called DeepSeek. David, when I think of China, I think of it as being derivative, a parasite, really. China's very good at spying on us and stealing our technology and so forth, and working with it and maybe making some improvements. But I usually see the U.S. as in the lead and China trying to catch up with us. Has China stolen a march on us when it comes to artificial intelligence?
Well, at first glance,
are we chasing China?
It certainly appears so at first glance. However, I will tell you, one of my good friends, David Nicholas of Nicholas Wealth Management, they're in the Atlanta area. He was actually recently on Fox Business just the other morning. Coincidentally, he'll be coming to the Tax Mastermind this week. He'll be visiting us here. But David's a good friend of mine. He's the one I actually got to ring the New York Stock Exchange bell with last year. So David was actually on Varney and Company and discussing this very issue. And some of the facts that are coming out here is it really true? Did they really get this to work with a smaller amount of GPUs? So you understand is OpenAI, which is basically owns ChatGPT, and you have all these versions of AI. There's over 400 AI companies in Silicon Valley now, right? And they're all trying to figure out how to make these language learning models work. And it's the earliest form of AI, but basically it scours the globe for information and tries to give you answers in very quick real time, right? So it can speed up productivity. But the amount of GPUs, these very expensive chips that Nvidia is the world's best producer of, is insane. And that's what's driven their sales and the price and the margin they've been able to hold on these products. Well, if this is true, over the weekend, the epiphany, this came out Friday, but no one it kind of took the whole weekend for people to realize, well, wait a minute. We wouldn't need to do all this capital extra expending, right? So last year, Meta, Amazon, Apple, the Mag 7, right, the Magnificent 7 stocks spent $66.8 billion last year on chips they're not even using, right? Just because they do not want to get behind in the arms race. They do not want to let somebody else have the chips and when they need them. Well, do they need those chips? We don't know. If DeepSeek's reality that they produce this is much less, you understand, it's a 9.3x efficiency. Therefore, Nvidia would have to get smacked in price. It would go down 90% potentially, right? And we saw it get knocked 17% on Monday.
Let me read one sentence from the Bloomberg story here. Then came DeepSeek, a Chinese startup whose AI platform appears to look as good as anything on the market at a fraction of the price and a sliver of the energy consumption, which is what you were just talking about.
Well, and again, I'm going to reference my friend David Nicholas. There are stories out there, and I asked him to actually get me some more information, but there are stories out there that maybe some of these HB1 visa workers that were Chinese were smuggling some of these chips out of the country because, as you understand, there was a law you couldn't sell these chips to China to keep us ahead in the arms race. So maybe they actually are using way more chips than what we think they are, and maybe they're not as efficient. Again, this story will unfold quickly, and we'll find out. But if it is actually true, then there's going to be a major price resetting in the marketplace. Now, I've been talking about the overvaluation for a little while now. Markets can get irrationally exuberant, Greenspan's old saying from 1996. And so certainly this could be the catalyst that sees the market roll over. I will also point out the NASDAQ, which is tech-heavy chip, has started to roll over for sure. And we're seeing a divergence between that and the other major indices, the Dow and the S&P. The last time we saw this divergence on a monthly chart was exactly 2 years ago, or 3 years ago, January of 2022. Well, I don't know if you remember, but the markets lost over 22% that year, all the equity markets, and the bond market suffered a 15% loss. So risk appetite, you might want to understand if you're overextending your risk at this point, but this is definitely going to lead to a repricing of the market. The question is, does it do it right away or does it do it slowly over time?
Well, what sounds ominous to me is that the markets have been doing well, even though you've noted before, oftentimes there are weeks in which a majority of the S&P 500, for instance, is down, but that Magnificent Seven has been carrying it for a year or two. But the shockwave that hit Nvidia, this is a shockwave that could hit the Magnificent Seven, right?
Yeah, and so what we would want to see.
That's why this is so ominous.
So if we want to see the markets take the next leg forward, right? So I don't think we're going to make super all-time highs. We can certainly make new all-time highs here in the very near future, but we're either going to do one of two things, Chip. We're going to enter what we call a trading range for the next 2 to 4 quarters, where the markets kind of go up and down at a 5% range while earnings catch up. And so to see that, you need to see a broadening out of the market. Now, the good news in January, we have top 3 sectors up over 6% each is communications, healthcare, and financials in that order. So those sectors which were not performing while the Mag 7 was running in the last 2 years are actually leading the market. So we're seeing a sector diversification. That is healthy. That's a breadth of market. But what we're not seeing is the money flow follow it yet. So to see conviction, we would need to see more money flows in there. Right now, it's very light money flow. Even though they're outperforming, they're not getting chased with the big institutional dollars. So we're either going to correct from here, reset the prices to a normalized value, or we're going to get in a trading range for a while. So again, do you have a performance plan? Do you have an allocation that diversifies you in a way that you could sustain both of those scenarios? That's what you need to be thinking about with your portfolio. And we would be happy to run a complimentary risk analysis and show you what the volatility or the beta of your portfolio is.
Well, fortunately, we have the analytical tools and the software programs and so forth to track all this and keep track of it, including how it might affect your portfolio.
Well, I will tell you is if you want to, if you're a podcaster, there's a great podcast called All In. It's got kind of left, right, and center, all Silicon Valley billionaires, right? And David Sachs, he's the right-leaning one on there. He actually is now the head of crypto for the White House. He's basically the czar of crypto and digital assets, and so I think you're going to see a lot of good minds get together to figure out what this looks like. But if you want to listen to that podcast, Ray Dalio, who's one of the greatest investors in our history, is featured this last week on the podcast, and I think you'd be well suited to listen. That's a good listen to. It's a long, lengthy one, but Ray talks about you've got to get non-correlated assets in your portfolio. If you have 8 different asset classes that are non-correlated, you reduce your risk according to his measurements by up to 83%. That's huge, Chip. Huge.
That'll do it for this week, folks. Please visit our events page at retiresmartomaha.com. David, did I hear you tell Sean earlier retiresmartnow.com is operational?
It's live and running.
All right. Well, you'll get to us either way. At the website, you can see everything we currently offer. There's no charge and there's no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.